General Motors and the Honda Motor Company both have sufficient current assets to cover their current liabilities, so they do not have any short-term solvency problems. General Motors has maintained a fairly stable amount of inventory, and accounts receivable have been very consistent except for an increase in 2014. It has been reducing the amount of cash it has on hand over time, which indicates that the company is becoming more efficient. Honda Motor Company has maintained a stable amount of inventory and accounts receivable. It has also been reducing the amount of cash it has on hand over time, and the company appears to be operating very efficiently. I like Honda Motor Company more than General Motors in terms of short-term solvency because its inventory and accounts receivable are more consistent. Honda Motor Company also has less cash on hand, which indicates that it is more efficient with its current assets than General Motors. General Motors has more leverage than the Honda Motor Company, but both companies appear to be gradually decreasing the amount of leverage that they have. Looking at the times interest earned ratio, for every dollar of interest General Motors owed from 2012 to 2014, it always had at least $12 of earnings. And for every dollar of interest Honda Motor Company owed from 2010 to 2014, it always had at least $73 in earnings. Although General Motors has a lot more long-term debt than Honda Motor Company, it can afford to pay it. Honda Motor Company is not highly levered, and it can definitely meet its long-term obligations. The company may even want to consider taking on a little more debt if it would increase the value of the company. I like Honda Motor Company more than General Motors in terms of long-term solvency because it has a lot more earnings relative to the amount of interest that it owes. From 2010 to 2011, General Motors' ROE increased by 8.5%. Its total asset turnover did increase from 0.99 to 1.06, but the increase in ROE was primarily driven by the company's tax break. If its interest, taxes, and leverage would have remained constant, its ROE would have only increased to 21.31% in 2012. From 2011 to 2012, General Motors' ROE decreased by 10.21%. Its taxes did increase tremendously, and the company was paying more in interest, but its leverage actually increased, and its EBIT margin fell to 19.94. Its total asset turnover decreased as well. From 2012 to 2013, General Motors' ROE decreased. Its leverage did decrease, but its EBIT margin only increased to 3.30, and its total asset turnover fell to 0.98. The company was also paying less in taxes and interest. If its leverage would have remained constant, its ROE would have still decreased to 13.05% in 2013. From 2013 to 2014, General Motors' ROE decreased. It was definitely driven by the company's poor performance because its leverage only decreased by a small amount and it was paying less taxes and interest. The decrease in GM's ROE was primarily driven by the decline in its EBIT margin and total asset turnover. If its leverage would have remained constant, its ROE would still have fallen to 7.89% in 2014. Overall, General Motors' ROE only increased in 2011, and although the company's higher total asset turnover did contribute to the increase, its higher tax burden is what was driving it. From 2010 to 2011, Honda Motor Company's ROE increased. The company was paying less in taxes and interest, but its leverage actually decreased. Its higher EBIT margin and total asset turnover is what drove the increase in its ROE, because if its taxes and interest would have remained constant, its ROE still would have increased to 9.57% in 2011. From 2011 to 2012, Honda Motor Company's ROE decreased by 7.39%. It was driven by the company's poor performance because although it was paying more in taxes, it was paying less in interest and its leverage remained the same. Its EBIT margin fell from 6.38 to 2.91, and its total asset turnover decreased as well. If its EBIT margin and total asset turnover would have remained constant, its ROE would have only decreased to 11.85% in 2012. From 2012 to 2013, Honda Motor Company's ROE increased. The company was paying less in taxes and its leverage did increase, but the increase in its ROE was driven by the company's good performance because it was paying more in interest and its EBIT margin and total asset turnover both increased significantly. If its EBIT margin and total asset turnover would have remained the same, its ROE would have actually decreased to 3.59% in 2013. From 2013 to 2014, Honda Motor Company's ROE increased. Again, it was driven by the company's good performance because although it was paying less in taxes and interest, its leverage decreased and its EBIT margin and total asset turnover increased. If its tax and interest burden would have remained constant, its ROE still would have increased to 9.74% in 2014. Overall, Honda Motor Company's performance was consistent with the changes in its ROE for the entire 5-year period, and its ROE increased every year except for 2012. To conclude the DuPont analysis, I like Honda Motor Company better than General Motors because throughout the entire 5-year period, General Motors' ROE only increased once, whereas Honda Motor Company's ROE only decreased once. Over the entire 5-year period, General Motors' ROE decreased by 12.37% and Honda Motor Company's ROE increased by 4.55%. General Motors' EBIT margin decreased during the entire 5-year period except in 2013, which is when it increased to 3.30 from negative 19.94 the previous year. Its total asset turnover also decreased throughout the entire 5-year period except in 2011. Honda Motor Company's EBIT margin and total asset turnover both increased during the entire 5-year period except in 2012. Overall, from 2010 to 2014, General Motors' ROE only increased in 2011 and it was primarily driven by its higher tax burden, whereas Honda Motor Company's ROE increased every year except for 2012, and the company's performance was always driving the changes in its ROE. From 2010 to 2014, both companies' profit margins were consistent with their ROE. General Motors' profit margin decreased every year except 2011, and Honda Motor Company's profit margin increased every year except for 2012. General Motors' average profit margin was slightly higher than Honda Motor Company's from 2010 to 2014, which indicates that it was generating a little more net income from sales than Honda Motor Company. However, because General Motors' profit margin has been falling since 2012 and Honda Motor Company's has been rising, I like Honda Motor Company better than General Motors in terms of profitability. From 2012 to 2014, General Motors' price-earnings ratio only increased in 2013, and it is currently lower than it was in 2014. This indicates that the market has lower expectations for the company's future growth relative to its earnings last year. From 2012 to 2014, General Motors' market-to-book ratio only increased in 2014, which could possibly indicate that the company is starting to become more efficient with shareholders' money, but only 1 year of data is not enough to be certain. From 2010 to 2014, Honda Motor Company's price-earnings ratio only increased in 2012, and it is currently higher than it was in 2014. This indicates that the market does not expect the company's growth to increase consistently each year, but it does expect it to continue growing over time. From 2010 to 2014, Honda Motor Company's market-to-book ratio only increased in 2012, which indicates that the company needs to use its assets more efficiently to generate cash flows. Based on the company's price-earnings ratio since 2010, it appears that the market expects more growth from Honda Motor Company than from General Motors on average and in the future. Based on their market-to-book ratios, neither company is very efficient with the money that their shareholders have put up, but General Motors actually seems to be a little more efficient than Honda Motor Company. General Motors' current price-earnings ratio is 7.13, so the market expects its future cash flows to be worth 7.13 times the amount of its earnings last year. Based on its price-earnings ratio and its earnings per share next year, General Motors' stock price is expected to be $32.15 1 year from today. Based on Honda Motor Company's current price-earnings ratio and its earnings per share next year, its stock price is expected to be $37.65 1 year from today. In terms of market value, I like Honda Motor Company better than General Motors because the market expects more growth from Honda Motor Company in the future. Its price-earnings ratio increased from 10.48 in 2014 to 13.28, whereas General Motors decreased from 8.58 in 2014 to 7.13. Also, 1 year from now, Honda Motor Company's stock price is expected to be $6.21 higher, and General Motors is only expected to be 65 cents higher. Nonetheless, both companies need to become more efficient with their assets. Honda Motor Company's market-to-book ratio in 2014 is very concerning because it decreased by a significant amount, and it is very close to 1. If it falls below 1, the company will be generating less cash flows than its shareholders have in the business. In terms of economic value added, I like Honda Motor Company better than General Motors because both companies currently have negative economic value added, but General Motors is over 76 times worse. In terms of enterprise value, I like Honda Motor Company better. General Motors' enterprise value was much higher than Honda Motor Company's over the 5-year period, and it seemed to be increasing significantly after 2011. But the company's value increased by a much smaller amount from 2013 to 2014, which is concerning because of its inconsistency in the past. According to the dividend discount model, both companies are underpriced, but I like Honda Motor Company better than General Motors because it is underpriced by $36.38, and General Motors is only underpriced by $27.08. General Motors' largest supplier is Magna International Incorporated, and it accounts for 4.88% of its total cost of goods sold. Its largest customer is Avis Budget Group Incorporated, accounting for 0.86% of its total revenue. Honda Motor Company's largest supplier is Denso Corporation, and it accounts for 3.28% of its total cost of goods sold. Its largest customer is AutoNation Incorporated, accounting for 0.81% of its total revenue. In terms of suppliers, neither company is exposed to a substantial amount of risk because their largest suppliers only account for 3 to 5% of their total cost of goods sold. In terms of customers, neither company is exposed to much risk because both companies sell directly to the majority of their customers, and none of them account for a significant amount of their total revenue. I based my decision regarding the top company in each industry on long-term solvency, enterprise value, and the DuPont analysis. I decided to base my decision on these 3 components because they are some of the most important components that must be analyzed when evaluating a company. The long-term solvency component is important because it indicates how much debt a company has and whether or not the company can afford it. The enterprise value component is important because it measures the total value of the company. It is a theoretical takeover price, and it is more accurate representation of the company's value than market capitalization because it includes both debt and equity in its value calculation. The DuPont analysis is extremely important because it allows market participants to analyze what is actually driving the return on assets and the return on equity for a company. The Smucker Company outperformed McCormick in terms of enterprise value and the DuPont analysis, which is why it was the top company in the processed and packaged goods industry. Honda Motor Company outperformed General Motors in terms of long-term solvency, enterprise value, and the DuPont analysis, which is why it was the top company in the major auto manufacturers industry.